Welcome to The Drilldown, in-depth answers to oilfield questions. I'm Richard Spears, and today we have a special presentation. This is the 12th of January 2021, and my brother and I just did a presentation for the Society of Petroleum Engineers Mid-Continent section. We did it virtually, so we did it here from the world headquarters of the studio here in the magic city of Tulsa, Oklahoma. And this was a talk that was our standard question and answer period, with then questions from the audience on Zoom that lasted, well, we started at 11:30, we ended at 12:30. So this is a 1-hour program that we invite you to listen to. It sounds very much like a normal podcast. But if you are listening to this, we would invite you to follow us or subscribe to us on our YouTube channel, or you can follow us on Spotify and Apple, which has been available. I don't remember what our numbers are, but we've had somewhere around 1/3 of views and listens of our podcast and on our YouTube channel. But thank you very much for supporting us over the years, and welcome to this special presentation. We go through each one. Right. I'm going to ask them. You're going to answer them because you're the smarter of the two brothers.
You'll be the interlocutor. There we go. Yeah.
Well, there you go. I don't even know what the word interlocutor means, but you go right ahead.
You're asking the questions. Yeah.
Okay. So here's question number one.
Sure.
And everybody can tune out after the answer of this first question.
Yeah.
Unless you've got something bright you want to say first.
Right now?
Yeah.
Well, let's see. I always like to start off my talks with what happened on this day in history. And
what did happen on
January the 12th? So we all remember 8 years ago, 2013, the U.S. government turned down a petition to build a Death Star. So that had gathered a lot of support. And
was that the Republicans or the
well,
Democrats? Because we built it.
There were two reasons that they gave for not
doing it. Oh, really?
One is that they weren't in favor of blowing up planets. And the other thing was that the 850 quadrillion budget was a little too high. Now that we have the PPP program, it might sneak in there, I'm sure. But anyway, that was this day in history way back when. So with that in mind...
Death Star, budget.
PPP.
This is perfect okay,
Yeah.
so here you go. So we got this question from New York.
Okay, yeah.
Money guys. On an annual basis, the EIA, which I think is the Farmers Union, the EIEIO,
right.
expects U.S. crude oil production to fall from last year's 11.3 million barrels a day to 11.1 million barrels a day.
Right.
And there's always a bunch of views about whether that's true or not.
Right.
What's our take on how U.S. oil production will trend over the next 12 months, and where is it going to be at the end of this particular year? Because this sets up the other 9 questions.
Right. Yeah. Well, I think what we're hearing a lot from the field, from the operators that we're in contact with, is that many of them, particularly the larger publicly traded ones anyway, have the intention of holding production flat next year or this year at their Q4 level, or the level that they were exiting 2020 at. And
13 days ago.
13 days ago, yeah. So, and that was roughly, I mean, the numbers aren't in yet, but we were, as a nation, we were producing around 11 million barrels a day oil. The shale piece, the tight oil piece, was in the vicinity of 7.7 million barrels a day. So, but that I think is, broadly speaking, what operators hope to do, and they will use a combination of new wells drilled and fracking their drilled but uncompleted wells and putting those online. I think that's how they're going to try and get to or hold production level. But at this stage, I don't see production growing over the course of 2021.
But you also don't see production falling.
If the money's there, I think production can hold steady. That will be the key.
Because so many times, just if you looked at your body of work over the last 20, 30 years, you've seen that many times you've not been in agreement with the EIA at all.
Right.
Because you see oil, you see drilling activity, you see frack activity way in advance of what they their models drive.
Yeah,
But this is one where you line up.
Yeah,
with
we try and build our numbers up from the bottom up. So how many wells are getting drilled? How many wells are getting fracked? What's the initial production of the wells that are being brought online? How fast are they declining? So we've got assumptions for all those things. And I have to say, at this stage, one of the elements that we probably have the most uncertainty about is the productivity of those new wells being drilled. You know, we've seen that prior to the downturn, I'd say 12 months ago, it was pretty apparent that the initial productivity of new wells had begun to level off and wasn't increasing very much. We don't have a lot of good data that gives us much clarity about what happened over the past 12 months, what with wells not being drilled, all kinds of things going on. So that's a big, there's a lot of uncertainty in my mind about what will be the, what productivity, what direction productivity is going. And will we be able to keep it as high as it was? Is it growing? We just don't know yet. But that's one of those inside baseball numbers that will certainly guide how much oil is produced over the course of 2021.
So the barometer that everybody looks at,
Right.
or the thermostat that everybody looks at every Friday, is the rig count. And another question, or the question you get all the time, is we are well off the lows of rig activity in the United States. By the way, our talk really is today about U.S. land. We're a global company, but this is a U.S. land kind of focus on the chat. But rig activity is up quite a bit. What, 100 rigs?
Yeah, 100 rigs, about 40%. We bottomed out around 250 rigs. And
so the question is, question number 2 is, what's our expectation for active rig count on the last day of this year?
Oh, on the last day of this year.
On the last day of this year.
Exactly. Yeah.
And do we get there by having a rapid ramp up and then it's flat, or is it like water boiling a frog? It just gets a little warmer every week.
Well, again, if you listen to what oil companies are saying, it seems as if they'll be very cautious about committing capital to new projects, new wells drilled. Even if oil prices are $50 and can keep going higher. I think a lot of companies in their planning for 2021 have probably budgeted expenditures assuming an oil price of around $40 a barrel. So we're well above that right now, right?
I looked just before we came on. Anybody can look on right now with a halfway decent data plan. It's 52, 53 bucks. West Texas.
Yeah, that's both the spot price and much of the futures price for this year is north of 50 here for U.S. crude.
I'm drilling as if it's 40.
I'm drilling as if it's 40. Now, there's a couple of things we all have to be aware of, and that is the fact that about half of the oil production in the U.S. has been hedged, already sold at a price of around $43 a barrel. You know, operators went into the futures market and pre-sold their production, and so they're going to get a price on average of around 43. So they're not going to get that $50 price.
So it could be 70. They're still just going to get 40-something dollars a barrel.
So that's a constraint. It's
so that's 4.5 million barrels a day. No, 5.5 million barrels a day.
Something like that. Yeah.
Public school education. Well,
the other
at mid-40s.
Yeah, right. The other thing, too, is that, again, if you listen to the guys who are publicly traded, to the publicly held companies, more and more of the time they're saying things like, if oil prices exceed our target, that we're going to take those additional dollars and return them to shareholders and debt holders.
A dividend payment or a debt payment.
Right, exactly. Rather than go put it in the ground and hire a rig and start drilling wells.
How long do you think they're good for that?
Oh, I see. That goes into this question of trying to restore confidence amongst investors so that they'll actually want to own the shares of all these companies. And I think that's probably a multi-year project. I mean, they started working on this in 2019. 2020, of course, tore everybody's plans up. So we've kind of had to reset. I think it's at least another couple of years before there's enough of a track record that senior management for oil companies is actually able to deliver on these kind of promises before you begin to get folks back into investor types back into the sector. So I think for much of this year we'll see any extra cash flow not go to rigs but instead back to the shareholders. So my own estimate at this point is that we'll probably exit the year with 400 rigs, maybe a few more than that running. We're at 350 today, so it's not much of a growth over the course of 12 months.
Now, if you were going to handicap that bet, have an over or under,
right?
Would you say it's more likely that it's 450 than 350 at the end of the year?
I think yes. I think that the higher play is the bias there, and the reason for that is this: part of our look at that 2021 on a flat oil production scenario is that a lot of drilled but uncompleted wells get put online. Right, the industry has had thousands of wells in this drilled but uncompleted category, unfracked and unhooked up, and so those wells are getting worked on and put online. And the issue for an operator is, how many of those wells do I have? I'll put them online first. Once I get my uncompleted well tally down to a more manageable level, now if I want to keep production flat, I've got to start drilling new wells. So the great unknown, the other great unknown out there in my mind is how much of a drawdown, how much of this inventory, DUC inventory, can we pull down? And if I've overestimated how many drilled but uncompleted wells are going to get, show up in production, then the whole production value, you got to run more rigs. And so I could see where rig count under some scenarios could get over 500 if operators run into this into a wall when it comes to
DUC exhaustion.
Yes.
But
a bunch of exhausted ducks.
Last night about halftime, when it looked like there was no way in this lifetime that Ohio State could come back.
Right.
I started reading oil output analysis reports. I had to go to sleep.
What happens when you don't have a halftime show, I guess, right?
But I read one guy's very brief analysis that said that he thinks that DUCs really don't have that big an impact on, oil output in the United States.
Oh, really?
And my response to him was that, and because he said operators always have DUCs. They got to do. I drill a well. I got to complete it at some point.
Right. Yes.
And until I complete it at some point, that's a DUC.
Right.
But he said, but it's always that way.
Yeah.
And so I used a biblical analogy that said, just like the poor, DUCs will always be with us.
Yeah. Right.
And I think what I wonder is whether DUCs and the completion of DUCs really do have the ability to do much about, I don't know. I'm drilling at X, but I'm fracking at X plus 10.
Right.
Whether it really does have much of an impact.
Well, one way to look at it is this. A year ago we started off 2020 with 800 rigs running in the U.S. Right, and so we'd built up this inventory of drilled but uncompleted wells that was associated with a rig count of 800. Yeah. Now we drop rig count to below 300. Right.
Yep.
Well, I haven't fracked many of those wells, right? So there's
still
thousands of them, right? That are so at a 300 or 400 or even 500 rig count level, the normal work in process business is has many fewer drilled but uncompleted wells than back when you were running 800 rigs. So that's the inventory that's available for the industry to work off of, and for whatever reason, it will be. Operators will have worked through all that by the end of 2021.
Yeah, so, and that's really the big point.
Yeah, I think that's the issue. 2022, we'll see the industry here in the U.S. return to drilling in order to reach its production targets. Yeah.
It's at that point that I eat what I kill.
Yes, right, absolutely.
Right then, real time. So we get this question all the time because a lot of our work is related to mergers and acquisitions or investments.
Yes.
Well, that's full stop right there. But a lot of it's related to the frack world or those businesses that are around hydraulic fracturing.
Right.
So it matters a lot about what horsepower frac horsepower is available in the United States, or the way we think of it, North America.
Sure, right.
And how much is currently active and how much has been eliminated over the last year or two.
Sure. Well, you've got numbers.
Well, I
Right.
do, because according to us,
Yeah.
and we've been tracking horsepower since 2003,
Okay.
we had almost 26 million horsepower in all of North America. So North America is Canada and
Right.
U.S.,
Yeah.
but for the geographers on the call today, not Mexico.
Not Mexico. Right.
Sorry about that, Mexico. You're in Latin America.
Mm-hmm.
But
Yeah.
we will end this year, it
Uh-huh.
was 26 million. It will end this year at about 19 million. That's a huge pile of horsepower.
So-
still
On the ground.
on the ground, it could catch a job. Some of it right away, some of it right now,
Yeah,
and some
yeah.
of it with giving a new fluid in.
Right.
But get this, only 8 million of that
Yeah.
is deployed in the field this year,
And
catching jobs.
Working right now.
Working, or the mechanics have it
Yeah,
and
right,
getting it ready to
okay,
work.
yeah,
So
so-
8 million is the actual.
So
Think of it-
less than half of the available horsepower.
Yeah, and that's the maximum for the year.
Oh, uh-huh.
We're at 6.5 million right now.
Okay,
Or so.
yeah.
So here's what that means: is that's about 175 frac crews out working, and various people count, active frac spreads. Right now, there's about 145.
And what's the
working
number?
these days.
40,000 horsepower per frac?
45,000-ish or so.
Horsepower per frac spread.
Yep,
Okay, gotcha.
Yep.
So-
Halliburton, weirdly, has a lower horsepower per active frac spread because they're the biggest guys in the marketplace.
Yeah.
And so they're able to actually, have that spare truck back in the yard, and but it's
so
got
they
8
don't-
crews working.
Right, okay.
So,
so
it's able to keep a lower number. But for that company that's got 2 or 3 frac
Okay.
spreads,
Gotcha.
it's 50,000 horsepower. So we've got the ability to grow, or I think we're going to see the frac
Uh-huh.
crew count grow by about 30% this year. And you're going to see the
Okay.
rig count number grow from 350 to
Right.
400.
Yeah, 400 and change. Well, that's over the course of the 12 months. Yeah,
Yeah.
right. Yeah, we're already up from the low point, which was
Well, yeah.
350. So okay. Well, that suggests that there's still plenty of capacity on the frac service side. I don't see much change in what they're going to charge for fracking wells.
Well,
right?
exactly.
That
and that was
becomes
one of the questions.
the next question.
Is
right?
there any pricing pressure
Right.
on frac? Are you going to, as a customer, are you going to see frac prices go up? As a service company, are you
Yeah.
going to be able to raise your price any? And
Yeah, so from the standpoint of if you're sitting in the operator side of the table, it's a great situation because I think your costs are pretty much static over the course of the year. We'll be seeing activity go up at varying rates depending upon the category.
Yeah.
But again, the asset utilization, the employment numbers are so low that there's really not much pricing power in the hands of the service industry yet.
If you were thinking about the various seasons in the life of an oil company,
Yeah, okay.
this would be one of those seasons where this is almost the best of all worlds.
Yeah.
Because you've got a $50-something oil price. You're spending as if it was $40-something.
Yeah.
The cost of getting a well drilled, completed, produced is as low as it's ever been.
Yeah, right, yeah, right.
Speaking. And so this should be that time
Right.
when a dollar that comes in the door dumps to the
Goes
bottom
furthest,
line
goes-
and is
yeah.
available for debt reduction
Yeah,
and
those kind of things.
and dividend payment.
Right.
You would think, right?
Yeah. Yeah. No, this is smart. And so everybody, again, on the oil company side of the table wants to go long on their contracts.
Yeah, that's right.
Sign me up for 2 or 3 years. Where the service company guys are
You
like,
gotta
no,
be kidding.
I don't want to. Yeah, because they're holding out for the day when they can begin to claw back some of the discounts that they've given over the past year. So, I mean, we track the change in costs in the U.S. oil field, and over the course of the past 12 months, broadly speaking, we've seen the cost of drilling and completing wells go down by about 15%. It's been more than that in some categories and less than that in other categories, but those costs have come down. But that's almost entirely come out of the whatever the gross margins were the service companies were enjoying. So they'd like to get some of that back.
And by enjoying, that is the correct word.
Yeah.
Gross margins, I enjoy those. Net margins, I enjoy even more. If you look at people ask us, so what is the actual size of spending on completion related work over any period of time? And if you look at just frack,
right,
and you look at how much money was spent on frack jobs each quarter.
Oh, okay.
The low point was Q2 this past year.
Right.
So April, May, June.
Right.
April, May, June, $1 billion was spent on frack jobs. And now just as a reference point, I think the high back in 2014 on a quarter was $8 billion in a quarter.
Right.
So Q2 this past year was the low point, $1 billion. This quarter, the one we're in right now,
first quarter of this year, okay,
$2 billion.
Okay, so it's gone from 1 to 2. Okay.
And so the high case for this year gets us to $3 billion in the fourth quarter. It's probably more like $2.5 billion in the fourth quarter. But what you see is there's more dollars being spent on frack work and going to the frack service companies and employing frack guys and coil tubing operators and rental folks and build locations and do those sort of things. More dollars, but still, it's just a shadow of anything you saw in 2018 and anything you saw.
Another way to sort of measure that is, again, in an environment where U.S. oil production is basically flat this year, we'll frack about 8,000 wells here in the U.S. Okay. In 2019, we were fracking twice that number. So
oil production was rising.
And oil production was growing at 2+ million barrels a day over the course of 12 months. But 8,000 fracked wells is better than the 7,000 that we fracked last year. A lot of them in the first quarter of last year,
which
and not so many afterwards.
Production drops.
Yeah, right. So that's
and this year the number is 6.
Well, it'll be 8 by the time it's all over. We'll probably have fracked about 8,000 wells here in the U.S.
Okay, so there's your 11 million barrels of oil a day.
Yep.
All right. So, what were our thoughts on industry consolidation?
Ooh, good
And
point.
there's two sides of that, right? There's the oil company side and the service company side.
Right. But where we've seen obviously some pretty big moves. We're sitting here in Tulsa, right? So WPX and Devon and so on.
Rick Muncrief has way less distance to drive to get to his job as of this week than he did the prior week.
Yeah. So it's not surprising to me. I would say that we've seen more consolidation on the oil company side of the table than on the oil field service firm at this point.
Yeah. Okay. Just say that again.
Yeah.
Oil companies have consolidated.
Yeah, we've seen
more.
some big. There's 3-4 big consolidations that have taken place already. There may be a few more if balance sheets firm up and look a little bit better.
Well, and those were the big those are big public ones. There's been a bunch of private ones that were consolidated.
Absolutely right. And we've seen some mergers going on the service side of the business yet. But the sense I have is that we'll probably see more of that kind of stuff pick up as time goes by. So as 2021, 2022 unfolds, just because I think as the service sector gets a little bit more confident about where activity is going and what their prices are going to be and so forth, I think we'll find some buyers and sellers begin to get a little bit closer in terms of valuations and be able to strike a deal. Yeah,
this is their expectations become more aligned.
Yes, absolutely.
But one of the things we alerted our clients to a few months ago was if you're an oil field service company, the thing you've got to really care about is who is the winner, who's the acquirer whenever two oil companies get together. Okay. Because it matters a lot. If you are, for example, what you're seeing in West Texas, where I've got Parsley being acquired by Pioneer. If you're a Parsley service company, you're fixing to be out in the cold.
Okay, so again, both Pioneer and Parsley operate in the same geographic
area.
Their geographic footprint is the same, yet they have different supply chains.
And they really do. The only thing that's common was the drilling contractors. Hey, they used, I think, the same 2 or 3 drilling contractors.
Both of those coming. Okay.
But everybody else
Right.
from there on down, it looked remarkably different.
So again, what we find, what I've always found, is that the buyer, the acquiring company, gets to choose whose supply chain he'll continue to use, and
That's it.
they prefer the incumbents on the acquirer's side.
I
right?
know those guys.
Yeah.
And oh, by the way,
Yeah.
the acquired companies, engineers and supply chain people,
Right.
they tend to get their walking papers.
Yeah.
And so who gets left over? So as a service company, you've got to pay a ton of attention about who was I working for, the acquired company or the acquiring
Right.
company.
Yeah.
I want to be the acquiring company. And then there's the other aspect, which is
Yeah.
about resulting size of the oil company. Because what's the rule we see?
Well, yeah. Again, as oil companies get bigger, they tend to prefer using the larger, more established oil service firms. So many small independent operators will use small tier 3 service firms, right? That's who they can get to answer their phone. But as a company gets bigger, whether it's through organic growth or through acquisition or whatnot, all of a sudden it just seems that they want to pair off with other similarly large service firms. So that would be the other thing that may not play out right away, but certainly you could expect that if you're a large service firm and you're seeing companies merge, that begins to look like an opportunity for you. If I'm not already in their supply chain, maybe this gives me a chance to get there. So,
yeah, so as we look at this year and the coming years, it's one of those seasons where a company like Halliburton
right.
tends to see its overall market share of the available work rise. And whenever things heat up again, and Halliburton goes into a heated market, kind of fully employed. And so it's those other independent service companies that have the ability to go, I can get a crew out there for you, I can get a rig out there for you, I can do those sort of things.
Yeah, no, it's an interesting time if you're a service firm, because the history of the service industry has been that they sell availability, right? They'll charge a premium for it, but if you need something, I can get there fast, save you time, and I'll charge you a lot of money. And so there was this incentive on the part of service firms to always retain some spare capacity to handle those hot shot kind of calls that I need you out here right away. Or we decided we're going to drill a well, let's get things going. And but now the emphasis with shale drilling, multiple wells per pad, large programs, one cookie cutter looking wells, it's all about how efficient can you make that process, and how much can you drive cost out of the process. And now from a service firm, they don't have as many customers who are willing to sort of pay them, who have that hot shot, call in mind, because again, you're trying to engineer those emergencies out of the drilling and completion process. So now the service firms don't have the incentive to have, to put extra dollars in assets, just idle assets that are available if needed, right? So there's that kind of change going on within the service sector as well. That I'm sure will ultimately improve returns to shareholders, but right now it's a tough process because you've just got too many assets chasing too few jobs.
What's really maddening to folks on this call, because it's the SPE Mid-Continent section, a lot of engineers, heck, we are, is that in an environment like this, there's actually not much room for engineering. You and I both, our other degree is in industrial engineering, which is all about processes.
Yes.
And it's all about processes. That's the kind of engineering that's used, as opposed to what's that particular well best designed. Well, what's the best design for that particular well? Right. Forget that. Give me the best average, and that's what the engineering.
Yeah, we kind of moved from a job shop approach to an industrial process. Yeah.
I'm going to ask 2 simple questions.
Okay.
And then I'm going to give you that'll be the 10 questions. I'm going to give you an 11th.
Oh, okay.
Which is going to roll in our tobacco conversation.
Okay.
And then I'm looking over here at Charlie and say, do we have any questions that are coming in? So there are no questions. If you want to type in a question, that's great. If you don't want to type in a question, we may continue, we may not. Okay. But here's the 9th question.
Okay.
As you look across the spectrum of product lines out there, So this is from an investor point of view,
Mm-hmm.
but they're really thinking about service company product lines.
Yes.
So a product line being drill bits,
Right.
directional drilling, frac jobs.
Yeah.
Do you see any tightness in the market? Well, and that's the question. Do you see any tightness in the market for services?
In the North American market in 2021?
Actually, the question was on the planet.
Well, the short answer is no, and the long answer is no. Yeah. So not for the coming year. No, they're just that we won't be returning to anything like the 2019 activity levels. And I understand that companies have parked equipment and they've laid off folks, and so the capacity of the service sector is less than what it used to be. But they're still a long ways away from shortages. So,
If you look at where that answer has been, no and no.
Yeah.
You saw it in 2016. You saw it in 2009. You saw it in 1999.
Right. So previous, recovery phases off of what were at the time, historic lows, right?
Yeah. If you look at the 10-year period, that 9-year period from 1999 when the price of oil was at that time almost negative, $10, the 10 years after that were some of the biggest growth years, biggest boom years, the most sustained boom term of the oil and gas industry's ever had.
Right.
It made so many gazillionaires that it was remarkable. And then after 2009, disaster year, you had the economy's collapse.
Right.
And so 2009 to 2014, so a 5-year period, stunning wealth generated in the oil and gas industry because I'd under-drilled, and now it became an oil supply problem, not an oil demand problem.
Yeah, right.
Because oil demand was bad in both cases.
Yes.
And I had too much supply, not enough demand. And anyway, what followed after that were stunning times. And that's just a defining factor of why we see growth in the U.S. oil and gas business in the current year, because last year was so bad.
Well, yeah.
All right, last question, and then I'm going to ask you the tobacco question after that.
Okay, right.
Talk of ESG pressures,
Right.
and that seemed to come to the fore across the industry last year.
So,
what are your thoughts on how ESG goals might shape the oil field in coming years?
Okay, so ESG, environmental, social, governance, right?
Yep.
But really for the oil patch, it's all about the E part,
It's
right?
the E part.
And that is a couple different things. One is oil companies themselves. Well, there are investors who aren't willing to touch anything fossil fuels with a 10-foot stick, right? At this point, they're just divesting themselves of the sector. So that's just a fact of life, and I don't see that
right
going
or
away.
wrong, doesn't matter. It's just the way that
it
is.
emerged in Europe a 3 years ago. It's now here in the U.S. And so, and there's something like 10% of the funds out there have ESG objectives. So, but what that has also then resulted in is any number of the publicly traded oil companies adopting, sort of defensively, as it were, some environmental related targets, along with returns to shareholders. Is going to be things like reducing their carbon footprint, eliminating methane, things like that. So we're beginning to see some operational effects of these kinds of goals on the part of oil companies right now. And longer term, when you hear companies like BP, Total, and others say that they're going to take 25% of their investment budget and put it in renewables, meaning that there's a smaller bucket of money left for investing in oil and gas, that's going to tighten up the supply side of the business over the next decade, 15 years, as those kind of programs on the part of oil companies get implemented. But I think the other interesting part is, what does this mean again for service companies, right? Because now you have oil companies who have targets for their for climate change initiatives and whatnot, and I'm pretty sure they're going to want to use service firms who service firms themselves have targets for reducing their
that align
resource.
with
Yeah,
the oil company's own objectives.
Right. Yeah, and that's a real challenge because again, it's sort of like what was happening 20 or 30 years ago when safety began to be the key thing, right? You began to
That's exactly the parallel.
Yeah.
Where I've got these independent organizations that track, or me as a service company, I've got to submit my safety record. Then the oil company fires up that safety record and says, oh, look, company A and B, they satisfy that requirement. We're going to allow them to bid. Company C doesn't.
And so.
Or they didn't submit anything.
Right.
They're not going to get to bid. And I think there's an ESG thing that emerges that says, I've got an ESG thing that I've plugged in.
Right.
And I've got an independent referee that says, hey, look, it aligns with Shell.
Right.
And so they get to bid.
So not just your price anymore, not just your availability, but that too will become a criterion for selection.
So before I go to the tobacco question, Charlie, we've got some questions coming in. I can't read them from here. Would you tell me what you think? It's Charlie Spears, by the way. His office is at 6th and Boston, but he's sitting right here because he runs our studio for us. By the way, if any of you nut jobs on this call ever want to convert natural gas to Bitcoin,
don't talk to me.
Don't talk to me. Talk to Charlie, because that's, I don't know what they're doing, but they've got a server farm in Kuwait, Oklahoma that blows my mind, turning natural gas into Bitcoin. And
good luck.
These hippies are doing it. So what's a question that you find interesting?
Great. This one's from Luis.
Mm-hmm.
And what percentage of revenue from large oil field service companies do you expect to be outside of the industry by 2022? How likely are these oil field service companies to be successful at diversifying outsed the oil industry?
That is such
because we've been hearing more about that, right? Yeah. So the thought being that as oil companies themselves are pivoting toward renewables, right, and non-fossil fuel investments, what does this mean for service firms, and what opportunities might exist for them to pivot toward renewable, something like Charlie says here, the question is outside the oil industry.
Okay, so what have I always said for my entire career about what the oil field rewards?
Oh, it rewards a specialist.
That's right.
Always.
I'm going to say it again. The oil field rewards the specialist.
Yeah, right. Mm-hmm.
And so, and you see it over and over and over again.
Mm-hmm. Who's the best at this?
Yeah. Right. Yes. And in fact, there's whole organizations that track who's the best, who's the customer thing, and that the stripes on that zebra are not going to change. The question is, can Halliburton or Schlumberger or Baker, can they still be the best, the specialist in category oil field, and also become the specialist in category whatever?
Wind power, right? Okay.
Yeah, can they do it? And my bet is they can't.
Yeah. Well, I sort of get to the same point, a different route.
And that's why there's two of us.
And that is just that you take the skill set that so many of the oilfield service firms have right now, and you look about, well, where can they apply those outside the oil patch? And there's just not that many. There are some geothermal wells that get drilled, for example, right? Yeah. There are some, and so that might keep a few rigs and a few, like crews busy.
10.
Yeah, maybe. Yeah. So there are wind turbines that get put in offshore, and so there's some work for
big heavy lift vessels.
Offshore construction guys to do that kind of thing. But again, the relative to the business they're doing even today in the oil field, there's just those kind of opportunities are pretty de minimis. So I think if to the extent they do diversify, it's going to have to come through acquisition, where they just go off and buy somebody who's not in the service sector, the upstream service sector, but serving a different industry today.
I think those people who are old-time Schlumberger folks on the call, who remember the SEMA acquisition years ago, it destroyed so much value of Schlumberger.
That was their electronics
It was.
business, right?
It
Yeah,
was.
yeah.
They were trying to diversify,
Yeah,
and
yeah.
it just crushed their business.
It's tough,
because it was nothing like
Yeah.
energy, and they got out of it. Yeah.
Absolutely, yeah. And it's interesting because the shoes have been the other foot. Over the past 10 years, we've certainly seen any number of firms that weren't in the energy sector who decided that they wanted to get into the energy sector because it
how
was growing
well
so
did
fast.
that
Right.
work for them?
Right, and so they were from any number of businesses, bought a oilfield service firm, and usually that's all ended in tears. Yeah. So
We bought our drill bit company back from a company that
Right.
ended in tears.
Yeah.
Charlie, there's another question that you found that looks
Yeah, we got
good.
a bunch more questions, but
Yeah.
I'll pick one.
yeah.
From Larry Shepard.
Mm-hmm.
In light of your projection of 20 added frac crews this year from 145 to 165,
Mm-hmm.
and in light of the massive layoffs over last year,
Mm-hmm.
is there going to be a problem with recruiting the experienced employees required, given likely nervousness as to how long the job will last?
Whew, yeah, boy. And by the way, I think it won't be up 20. I think it'll be up 30. But still,
Yeah.
it's these sort of numbers because it's still half the size
Mm-hmm.
that it was just a year ago. So it's just a fraction of what it was. But it's this question about recruitment. Can you get a guy to come back? And I think that I think the damage was done to getting people to come back to the oil patch a few years ago when litigation just burned through the whole industry with regard to how you paid a guy out on a frac crew or on a wireline truck on a coiled tubing unit. Because, again, a few people brought litigation against every one of the service companies and said, you've got to be paid by the hour and maybe a stage bonus, but you no longer get to be paid essentially a fraction of the job. And it caused the amount of compensation that a guy could make out in the oil field to just collapse. It was great for the ownership group because my labor costs went down. But for the guys working in the field, the guys actually doing the work, it just caused their overall compensation to drop by 20, 30, 40, 50%.
Yeah.
And it made our ability to attract good guys to be really hamstrung.
So that happened from 16, 17?
Yeah, it was going on before that
Yeah.
a little bit, but it worked its way.
So what
all
you're
the
talking
way through.
about is this has been in effect for 2-3 years now for sure.
Yeah. So
Yeah.
now
So-
we run this situation where the great
Uh-huh.
crew change has happened.
Right.
Again, we're 65. You're just a little bit older. But it's hard for a guy our age to find an entry point in the oil and gas business these days because that group's been eliminated. Not everybody, but we're not in the mainstream anymore. So it's a far younger group of people, and the 20-year-olds of the industry and the population, they're still out there. They still want to work, but yeah, what a tough situation this is to be in. I think people do always show up. But
Yeah.
and they behave the very same way. If I make $1,000, I spend 1,001.
So perhaps the compensation approach has to change in some fashion in order to restore that incentive. But how that might happen, I don't know yet.
I've never figured it out.
Yeah. It's going to be hard, and I think the industry will have to pay more money to get enough people back if things begin to turn around. But again, I just don't see us as an industry that runs 2,000 rigs like we were doing.
What about
just
1,000 rigs?
1,000 rigs might be a stretch. Yeah. When you begin to think about.
I'll be 70.
Okay, so you don't have to run the 1,000 rigs. But I just think as an industry, we're the labor component won't ever be as large as it was just a few years back.
No.
Right. Yeah.
Charlie got another one over there that's interesting to you.
We have several good questions.
Yeah.
We'll take a big picture one, a macro one from Robin Jones. Why do you think the Saudis suddenly decided to play nice in the sandbox? What would make their mood switch again to a price war?
By the way, Saudi Aramco has been a great client of ours for a long time.
Yeah.
And even though it's hard for me to understand why the Saudis would hire a firm in Tulsa, Oklahoma, I believe that they use our firm to help them monitor the behavior of oil companies and service companies in the United States, as opposed to relying on us to help them
Help didn't say anything
in
about
their
it.
backyard.
Yeah, right.
And so they've been a great client for years, and we love all of our clients, but the Saudis included. But they did. They did say we're going to hold some off.
Right, March 6th last year, they were going to flood the market, right, to punish folks, bring them in line, because they were tired of holding barrels off the market, and now. Just last week, they announced they were going to cut production 1 million barrels a day in order to allow a few others to increase output and sustain price. I think the key is probably that price target. So many governments around the Middle East and that are oil producers wherever need a price that's in the $60 to $70 range in order to balance their federal budgets. Saudis included, because Saudis have a huge plan anyway to diversify their economy. It's going to cost a lot of money, so they need to see a higher oil price, and I think that realization it explains why they've changed over the past 12 months. What would it take for them to go? Why might they go back? Well, again, I think we have to understand that so much, why were the Saudis unhappy about cutting production back in 2018, 2019? Well, the U.S. output was growing 2 million barrels a day year over year, right? And so they were losing share to, those guys out in the Permian Basin. I don't see that happening. And so I think the chance...
You don't see Permian Basin
I don't see the Permian Basin growing at 2 million barrels a day. I don't think they'll be forced to cut production. They've got to do some now because obviously with the pandemic still going, the recovery in demand is still up in the air. So this year will be a challenge, and each month we'll probably just have an ongoing OPEC Plus will have an ongoing discussion about who's increasing how much, who's cutting how much, but that's just going to be a feature of 2021.
Let's have 2 more questions. Charlie, you got another one or that's interesting that you see?
Yeah, we have a bunch of interesting questions.
Is there a grand unifying question?
Yeah, we've got a few questions about LNG and natural gas.
Right.
What are you forecasting for LNG and oil exports looking forward with the new administration?
By the way, the last well I was on was in the Marcellus back in September on a mountaintop. And I was watching natural gas on that mountaintop being turned into liquefied natural gas on a couple of trailer units provided by Argentina's Galileo. And they were being then trucking that liquefied natural gas down the mountain to go into the local supply chain and over to another frack spread that was working.
Yeah, so it wasn't going abroad at all.
Not at all.
Being
it was
used
being
locally,
trucked from a mountaintop in Pennsylvania to a valley in Pennsylvania.
So there are those kind of opportunities that exist where stranded gas might be found.
Yeah, and I think there's bunches of those opportunities. So it doesn't have to be shipped anywhere. It's just transported more easily without a pipeline.
Well, LNG exports from the U.S., I think, are forecast to grow a stunning amount, like 20% over the coming year. Part of that's due to the global gas demand, again, recovering just like oil demand is.
So
recovering.
It's the economy.
It got hit, it's coming back, and on a global basis. And the U.S. is well positioned at the moment anyway.
And do you think the Biden administration is a factor?
I don't.
Good or bad?
I don't see much impact. Just because the teams change in Washington on LNG exports, things like that. The bigger challenge probably for the U.S. will be, do many more gas transmission pipelines get built, right? You think about where there has been a lot of pushback and where industry, even under the Trump administration, was in some deep sand, and that was trying to get new pipelines built, oil or gas.
Deep sand.
Yeah, right. And so I think that problem will only grow.
Pipeline construction is a problem if it crosses a state border, and that becomes interstate.
Yeah, right. But even intrastate pipeline construction, I think, is going to see more and more of a pushback.
If it's in the Northeast or the West.
So I don't see it so much of an issue as to what export policy might or might not be. I think the question will be, to the extent we want to grow production of oil or gas beyond its 2019 level, right? We're below those levels today. If we recover to those and want to grow above it, we'll need more of that kind of infrastructure, and that's going to be a challenge. That's going to be where we'll see things different, through 2024. From where
Charlie,
we've
give
been
me
today.
a good one for the last one, and then I'm
Yeah.
going to ask John my tobacco question.
Mhm.
They're all good ones. It's just it can't go on forever because
Yeah.
I lose John pretty soon, and you don't want just me.
Yes, sir.
Big picture, how do you see the heavy marketing of electric vehicles impacting the industry in the near term? Not long term, near term.
Okay, the first Tesla in the city of Tulsa, Oklahoma, I'm convinced it was by by Steve Cobb, who's a member of SPE here in the Mid-Continent region, and if I remember right, Steve has never let me drive that car for a couple of really good reasons, but one of which is I can get into it, but I can't get back out of it. But the Tesla's been around, and the other EV related cars have been around for a long time, and they fill a niche. We had a company in Houston, Texas that made the connectors that go in MWD systems, rotating connectors. And our head of manufacturing bought a dadgum Tesla. And I just about shot him. I'm going, "You're not on the team, man."
Yeah.
And he said, "I'm thinking about my own economics." And he was a complete fan. He made oil field products, and he drove a Tesla to work.
Yeah.
And he found it was it. So heavy marketing, what do you think in the short term?
Well, no. The key for the gas industry short term is not the transportation sector where gas use is de minimis. It's the power sector, and the fact that we're continually pulling offline coal and replacing it with renewables rather than natural gas. Right, that's going to be where any growth opportunity is going to be. So to the extent that we sell a lot more Teslas or any other electric vehicle, it's not going to make that much of a difference over the short term for either the gas side of the business or even the oil companies. There's just so much embedded demand in the existing capital base that won't be much of a factor. That's one of the reasons why I see these oil companies that talk about the demand curve, peak demand rolling over in 2030 or 2035, I think it's hard to get there really. Because in that short of a time, even in that 10 or 15 year time frame, I think it's something that's a lot longer term before we really begin to see something significant, occur. So I don't lay awake worrying about that at night with regard to affecting our business here.
If you, it's the guys who run Liberty Oilfield Services out of Denver, publicly traded frack company.
Yep.
They make, as a group, they make such great arguments for the moral case against electric cars. They fully believe in let people choose what they want to choose. But they make this point that there are subsidies that go to the EV world, electric vehicle world, and that go almost exclusively to the richest people in America, because that's who buys the electric
who can afford
cars.
to buy it, right?
And the burden of the cost of those economic benefits is on the shoulders of the poorest of Americans, because they're the ones who have to continue driving the internal combustion engine cars and pay road taxes. Road taxes have to rise on gasoline powered cars in order to, because I'm losing.
Unless we change the tax structure there.
Well, that's right. And what are the odds if I'm still subsidizing it? So they make this really strong moral case that says what we're doing is just burden the poorest of Americans and benefit the richest.
It's approach.
It's regressive on the poor and not on the rich. All right, last question. I'm going to throw it back over to Clint, and it's this.
Yes.
It's the tobacco parallel.
Yes.
The oil and gas industry tobacco parallel.
Okay.
About what did the tobacco industry do? Because it was industry non grata just like we are now, what did they do, and are they beloved? Why are they beloved today?
Beloved.
Beloved.
So 20 years ago, when those big first rounds of tobacco lawsuits came through, and we saw all kinds of, the tobacco stocks went just into the dumpster for a while anyway, because everybody thought this was the end of the tobacco industry. And then as it turned out, they were able to both pay off those large settlements and return great dividends to their investors. And so tobacco stocks.
Because Major League Baseball, everybody still puts a wad of
No.
Well, but we didn't end the use of tobacco.
That's right, exactly.
People still wanted to use it.
Absolutely right. So given that the companies, absolutely prioritize returns to shareholders, and depending upon where you want to draw your starting point, tobacco stocks have been one of the better sectors to be in, even if you look back 20 years or so. So I think that's the analogy that the oil companies are thinking about, that you've got a bunch of investor types who, because of fossil fuel, climate change concerns, however you want to categorize it, don't want to get anywhere near owning these companies, and that's one of the reasons why their shares have languished much. But that's the challenge then for the management of these publicly traded firms, is that they brush up their toes, focus on providing generous returns to shareholders, and I think at some point they'll see that effort rewarded in the form of higher stock prices, right? It may not be everybody who's willing to buy those stocks, just as there are people today who don't want to own tobacco stocks.
It's still a sin stock, not going to put it in the portfolio.
But in terms of shareholder decisions, I think that's the case. I don't see anything yet that prohibits people from owning shares of companies. But that's going to be incumbent upon management to meet the expectations of current shareholders and the potential shareholders that they might want to attract.
So I think we're going to draw it to a close right there. And Clint, I'm going to throw this back over to you for you to close up things.